Turn to the next paper. The next paper will be presented, is going to be presented by Dmitriy Muravyev. Dmitry, you have, please aim for 25 minutes with a hard stop after 30 minutes.
Okay. Thank you all for coming. This is joint work with Oleg Bondarenko, who is here. And in this paper, we introduce a big puzzle about average market returns, and then we'll try to solve it. So what's the puzzle? Let's look at how market return accumulate over a trading day from 6 p.m. Eastern time to 6 p.m. the next day. So these are average annualized returns, and those arrows show you then the major equity markets are open. We will use S&P E-mini futures as a proxy for the market portfolio because those actively trade through pretty much 24 hours a day. And then I first saw this figure, I was just, wow. I did expect that the market returns will be mostly during the overnight period, but I was surprised how kind of concentrated this period is. So 100% of market returns is concentrated between 11:30 p.m. and 3:30 a.m. So this is the time when US investors sleep. It's late afternoon in Asia, early morning in Europe. Returns during the rest of the day are close to zero. So you can see that during the Asian session, they're zero / slightly negative. During the subsequent European session and most of the US session, they're flat, except for the zigzag around the US close that has little effect on the net returns. So the goal of this paper is understand why equity returns are positive. So we will zero in on this 4-hour period, which we call EU Open, and try to understand what's going on. EU Open returns have a t-statistic of 6.3, and I don't think I comprehended what t-statistic of 6.3 means until I saw this figure. So the blue line shows how cumulative returns for EU Open accumulate during the sample period, and it's almost this straight line, and it's even hard to see this jiggle around the financial crisis. So EU Open returns are remarkably consistent. So what's new here? So from prior literature, we know that most of the equity premium is concentrated during the overnight period. And as Hussein Gulin told New York Times 2 years ago, we can show that there is a gap between day and night return, but at this point, we do not know exactly why. So here's our contribution. So prior literature doesn't observe prices at night. So we will introduce and look at this detailed overnight data and localize this period with positive returns, which immediately helps us reject some of the hypotheses in the prior literature. So it's not something interesting about US close, it's not something interesting about US Open, it's really in this deep night period. And as we reject multiple alternative explanations, one explanation that we cannot reject is uncertainty resolution, which help us connect to this old and important literature in finance and economics on uncertainty, with some examples of the recent work which relates uncertainty and long-term market returns. What's the plan? The first part of the paper is straightforward. We need to convince you that EU Open returns are robust, that indeed the most interesting period of the day, and finally to show that overnight period is liquid. I actually was very surprised how liquid overnight period is. You can literally trade billions of dollars, even during the Asian session. The second part is more difficult. So how do we explain it? And this is like this striking anomaly, very significant. So we will first show that this run-up in price is driven by opening of the European markets and not by closing of Asian markets, by looking at exogenous shock from daylight savings times. So it's really about European Open. This is why we call it EU Open. Then we will extensively test uncertainty resolution, which is our preferred explanation. In short, uncertainty is relatively low during most of the day, as there is a critical mass of investors who try to process information as fast as possible, except that uncertainty accumulates during the overnight Asian session. That's because Asian economy is important, but there are relatively few large investors operating in that time zone. So uncertainty accumulates during Asian period and then get resolved during European Open as the first European investors come to the market. So as uncertainty is being resolved, prices increase. This is why we see positive returns during EU Open period. We also consider other explanations. First, we show that if you buy before EU Open and you sell after EU Open, this strategy will be profitable after conservative estimates of transaction cost and has a pretty large capacity, so this is for real. We will take seriously the concerns about data mining and that maybe the realized returns are different from average returns, so we will run rigorous statistical tests there. Having t-statistic of 6 really helps there. We will also test inventory risk, so maybe overnight period is risky, as we saw from the previous paper, and investors want to close their positions, so dealers must be compensated for taking positions overnight. We will reject this explanation as well, and we will also consider news arrival, carry cost, investor sentiment, and so on. So that's the plan. Well, data and methodology. So futures returns have a couple of advantages. First of all, they are already net of the risk-free rate and they already account for dividends. That's nice. We will primarily use trade data, but we will also confirm these are real transactions, but we will also confirm that the results are almost identical if we use quote midpoints. Well, this is the most actively traded futures contract. Our sample starts in 2004 because this is the first year then CME extended trading hours to almost like account for 24 hours a day. Right now it's almost 24 hours except for 2 technical breaks between 4:15 and 6 p.m. All right, so I also want to emphasize that E-mini futures are traded on Globex. It's always electronic. There is no flow trading. So it means that I refer to Asian session or European session. It's exactly the same setup, exactly the same trading venue. It's just that potentially the investors are different. Anyway, in case you are not convinced by my first figure that EU Open is special, let's pick your favorite 1 hour period of the day. Let's compute its return and t-statistic, and then I will do it for every 1 hour period through the day. So what you can see is, except for EU Open in a gray, there are only 5 other brief instances, then 1 hour returns are significant at conventional levels. And if we extend the window to 4 hours, EU Open is clearly the only significant period. So EU Open really stands out. Let's look at EU Open return distribution. So it's 7.6% annualized return. Volatility is lower during EU Open because, well, volatility is generally lower during non-trading hours, which adds up to a very high Sharpe ratio of 167%. That's just huge. Interestingly, returns have positive skewness during EU Open, which many investors prefer, even though for the entire day, the skewness is negative. Well, kurtosis is larger for EU Open, and we especially check that EU Open returns are not due to outliers. You already can see that for EU Open, the maximum you can make or lose is about 4%. All right, EU Open returns are positive and significant in every weekday, every calendar month, and are positive in every year of our sample period and significant in most of those years, while returns during the rest of the day are almost never significant. If we split the sample into 2 halves, you can see that the returns paths deviate during US trading session. That's because of the financial crisis. But during the rest of the day, they're surprisingly similar from 6 p.m. till 9:30 a.m. So we see flat pot, we see EU Open run up, we see flat pot again. So EU Open, hopefully these results convince you that EU Open returns are extremely robust and consistent. We then carefully study trading volume, liquidity, and volatility during different times of the day. And even during the Asian session, which is the least active, S&P E-mini is the 4th most actively traded index futures during Asian hours. To give you some flavor, so during those 8 hours, $17 billion of exposure is traded with about 120 trades per minute. The bid-ask spread is almost always 1 tick or about 1.5 basis points. with about $6.5 million at the best bid and ask. Of course, if we move to European session, the liquidity quadruples, and it's also for Asian session, the liquidity improved a lot over the sample period. So even the Asian session is very liquid. Okay, let's move to the second part of the paper where we try to explain those EU open returns. And we will first look at the Europe versus European open versus Asian close. The problem here is there are two most important recurring events during this period, but they occur at the same time. So, for example, Frankfurt opens at 2 a.m., and so some Asian markets close at exactly the same time. Luckily for us, Europe and US observe daylight saving times versus Asia does not. So what it means, there will be a 1 hour shift during most half of the year. So these graphs show you what's going on during this half a year from the perspective of European and US investors. Nothing changes. So we see the same volume pattern, we see the same return pattern. Of course, the same pattern looks very different from the perspective of the Asian investors. So the same pattern in Japanese time. So we see a clear 1 hour shift in trading volume, but more importantly, we see a clear 1 hour shift in the returns. So returns stay the same in European time, they shift in Asian time, which let us conclude that it's really European open which drives up this price for now. All right, that's great. So let's focus on explaining what's going on. Our preferred explanation will be uncertainty resolution. So let me first explain what we mean by uncertainty, why it affects prices, and how all of this is related to this EU open stuff. So there are different ways to look at uncertainty. We will follow what kind of the Fisher's black idea. So his idea will be, well, that price can deviate from fundamental value. What is fundamental value? Well, this is kind of hypothetical price that will accommodate all of the public information. Why hypothetical? Well, because new information comes to the market every second, and it's almost impossible to efficiently process all of it. Right? So risk neutral investors do not know whether the current price is higher or lower than value, but they have a sense how far away it is. For example, right now uncertainty is high because, well, all of this COVID uncertainty about US elections. And there are several theoretical models. I have a couple of examples on this slide that argue that uncertainty is high, prices will be low because investors will require price discount. So then uncertainty is high, prices are low, then uncertainty is decreases, prices increase. So how is it related to what we see? So during most of the day, uncertainty is relatively low because we have a critical mass of investors that process the incoming information, except for the Asian session. So Asian economy is an important contributor to world GDP, so there is a lot of news. But Asian investors, there are relatively few large investors in that time zone. So they cannot process efficiently all of the news. So uncertainty and unprocessed news accumulate. So does the price discount. And then during the European Open, the first European investors come in, they process the information, and this is why the prices increase. Until uncertainty is resolved, price discount disappears, prices go up, we see positive EU open returns. Well, let's go and test it. We have about 7 tests of this hypothesis. First of all, European investors are crucial for this hypothesis. So what if we kick them out of the market? So if we kick them out of the market, EU open return should be close to 0, and the positive return should move later in that session than the first US investors come in, right? Then uncertainty is actually resolved. Well, we cannot physically kick out European investors, but there are a couple of days that it happens naturally. We look at the unique European holidays. So holidays, then Frankfurt and London exchanges are closed, but the E-mini market is open. Some of these are unique, such as Royal Wedding Day in Britain. Some of them are kind of recurrent, such as Boxing Day. We have about 81 such days in our sample. So we first confirmed that during the European session, volatility and volume are much lower during on those holidays. This is the last column. 50% lower volume, 20% lower volatility. Now, how about returns? Let's look at the second column. So returns during EU Open on EU holidays, so unique EU holidays, is close to zero. And where does this return go? It goes to the rest of the session. So here we have a return which is roughly comparable to what we see on an average day. So this is a nice exogenous shock to the resolution of uncertainty during EU Open, and we get the results which are pretty consistent with what we expect. The next battery of tests will look at how popular uncertainty measures affect EU Open returns. So the most popular uncertainty measure is change in VIX. So then VIX increases, EU Open returns, subsequent EU Open returns should be higher, and that's exactly what we find in the first column. Our hypothesis is also very specific that uncertainty during the prior Asian sessions should matter more than the uncertainty during the prior US session. How can we measure this uncertainty? Well, this uncertainty will be proportional to the amount of unprocessed information, which could be proxied by the trading volume or by the volatility during the Asian session. And what we see is EU Open returns are higher than Asian volume is higher, or Asian volatility is high on the previous session, while the sign for the prior US volume or prior US volatility is not nearly as significant. We look at other measures of uncertainty, implied volatility for the European index, where also those textual-based uncertainty measures developed by Nick Bloom and his co-authors. So economic policy uncertainty is based on the textual sentiment of US newspapers, while Twitter uncertainty is based on tweets. Those measures are positively correlated. This is why we'll look at univariate regression, changes versus levels, and try to predict EU Open returns. In all specification by one, we find a significantly positive relationship. All right, well, our story is very specific about how uncertainty changes during the day. So luckily, VIX futures allow us to observe the uncertainty around how uncertainty changes around the clock. So with our story, uncertainty resolution hypothesis predicts that uncertainty should increase during the Asian session, and it does. Uncertainty should decrease substantially during EU Open, and again, this is what we see in VIX returns. VIX returns are positive in the Asian session, and VIX returns are negative during EU Open, and VIX returns are kind of mildly negative during the rest of the session. And the 4-hour window shows us that Asian session is the only period then VIX returns are significantly positive. This is actually remarkable because we know from prior literature that VIX returns on average are very negative. That's compensation for variance premium. So it's really remarkable that you can find a positive VIX futures returns. So we also look at some conventional microstructure tests such as variance ratio tests, which show us that the prices are less informative and more noisy prior to EU Open, and then they become more efficient after EU Open, about 15% more efficient according to variance ratio test. So these results, particularly our results about EU holidays and VIX futures returns, kind of pretty much support the uncertainty resolution, but we'll also carefully consider other explanations. In particular, it's interesting to see whether trading costs matter here. So if you want to exploit this strategy, you need to trade twice a day. The trading costs add up. So after we adjust for the conservative estimates of trading costs, buy at the ask, sell at the bid, account for commissions, and especially for high exchange fees at CMEs, is the strategy profitable or not? So let's look at the baseline strategy. After the transaction cost, the Sharpe ratio falls to about 55%, which is still higher than the buy and hold Sharpe ratio of about like 35%. Of course, we don't need to trade every day. We previously showed that the returns are much higher than uncertainty is higher. So let's only trade on days where EU Open returns are expected to be higher than transaction costs, which is about 40 days. We will use 2 predictors from the uncertainty resolution hypothesis. And if we do so, your profitability doubles, your trading costs remain the same. And what you see is the after cost Sharpe ratio of 120%. So this is a pretty attractive trading strategy, and it's easy to estimate. Well, but what about trading capacity? Well, of course, it's really difficult to estimate trading capacity using public trading data, but under some simplifying assumption, here we're actually using one of the Albert's papers, we estimate that the trading capacity is about like between $6 and $9 billion. And the after cost profitability is about $50 million per year. So the capacity is roughly comparable to what you see for the stock reversal in the cross-section of stock returns, which was the top hedge fund strategy until recently. So this is a pretty sizable kind of anomaly, which you can potentially trade inside. So it's not just due to limited to arbitrage. Well, then we carefully study inventory risk. What is inventory risk? Well, some investors may dislike the overnight period for whatever reason. They will close position around US close. They will reopen this position maybe around European open. And whoever holds those positions overnight, which is presumably dealers, must be compensated. So according to inventory risk effect on average return should be positive during the entire overnight period, not just during EU open. But what we see is that average returns are just zero, even slightly negative during the Asian period. This is consistent with uncertainty resolution. This is not consistent with inventory risk. Inventory risk means dealers holding position overnight. Every hour you hold the position, you must be compensated. Otherwise, there will be free riders. We also run other tests which are based on weekends. We split the sample into two parts, one with the liquid overnight futures, the other with the liquid overnight futures. Doesn't seem like inventory risk fits the data. We also carefully look at data mining, which is what statisticians call multiple hypothesis tested. Thus, picking the best period of the day, which is EU open, affects our results. Another way to look at maybe the realized returns we'll look at differ from the true average return. So there are statistical tests to distinguish for this. The most conservative one is Bonferroni correction. The state-of-the-art test will be bootstrap reality check. So we do all of them. And they tell you, well, maybe instead of the t-stat of 2, you need to consider t-stat of slightly more than 3. So here, having t-statistics of more than 6 really helps. It also helps that EU open returns are just simply significant in every single year of our sample period. We also look at investor sentiment, but investor sentiment doesn't predict EU open return. We look at carry costs, but we don't see a big difference between EU open returns over the weekends versus weekdays. We look at the news arrival, but most of the news arrives shortly after US market closes or shortly before US market opens. In terms of big picture, our results matter because they provide us an example of how high frequency data can tell us something important, right? Normally we will look at longer horizons, but with the high frequency data, you can easier to confirm or reject alternative hypotheses. So let me conclude. So what they do in this paper, we show that 100% of average market return is concentrated during just a 4-hour period, deep in the night for US investors. These EU open returns are consistently positive and returns are close to zero during the rest of the day, which is an equally large puzzle. We consider a number of explanations, and the most likely explanation is uncertainty resolution. Uncertainty increases during the Asian session as kind of news are not entirely processed. And this uncertainty is resolved around the European Open and prices increase. This is interesting because in academic literature, we usually don't really care about European investors, but here they play a very important role. Finally, if these results are taken at face value, what this means is that equity premium is simply a compensation for uncertainty resolution and price discovery. So European investors are compensated for resolving uncertainty and for providing price discovery. Well, thank you so much. That's all I have.
Dmitry, thanks very much. The discussant is Charles Martineau from the University of Toronto. Charles, the floor is yours.
All right, just give me a second. See if I always struggle with this stuff. All right, there you go. Share, view, full screen. All right, everybody can see?
Perfect.
All right, cool. All right, well, thank you very much for asking me to discuss this paper. When Oleg and Dima wrote the first draft of the paper, they sent me a copy a couple months ago, and I already shared some early feedback with Dima. And they already incorporated some of my feedbacks already in the paper, but taking the time to read the paper more carefully over the weekend, I was able to come up with some additional comments. It's a very neat paper. It's just a quick summary of the paper. What Dima have shown and Oleg have shown is that if you, for example, if you calculate the cumulative return in the S&P 500 futures, starting, let's say, at 6 p.m. at night, you will see that there is a overnight drift of approximately, on a daily basis, about 3.5 basis points. But when you analyze this, this is approximately 7.60% analyzed. And all this drift happens between 11:30 p.m. and 3:30 a.m. And it's essentially, it coincides with the European Open. So on top here, I added the label of which markets open. So you have Japan, China, Hong Kong. So nothing really is happening here. But when Frankfurt and London markets start to open, this coincides with the increase in the drift. And the main punchline of the story of the paper is that this drift is caused by uncertainty resolution. So where does this paper fit in the literature? So there's been a growing literature documenting what I call, quote, concentrated significant risk premium. So the paper of Sever Wilson, 2013, showed that there's a large share of the risk premium occurs on macro announcement days. Luca and Monch as well, there's a larger significant risk premium that happens before FOMC announcements. Hu and Hal says, no, it's actually not only FOMC, but actually multiple macro news announcements. And Cheslak and co-authors found that the large share of the market risk premium occurs weeks around the FOMC announcements. So what Oleg and Dima show us is actually, no, the average risk premium is actually there almost like a daily basis on average. But it's really important to keep in mind that there's another paper by Bondarenko, Larson, and Paul Whelan that documents a significant overnight premium as well. So similar findings to what Oleg and Dima is showing in this paper. But what really differentiates Oleg from the paper of Bondarenko and co-authors is that Oleg and Dima have a story about uncertainty resolution, whereas Bondarenko and co-authors have a story related to inventory risk. I don't have this in my comments in additional slides, but I would actually encourage Dima and Oleg to actually look at the theoretical work of Ian Bansal and two of other working papers by the same authors that can better tie their story as to why there is uncertainty resolution in such a short time period. So I have three comments for Oleg and Dima. So the first one has to do with the overnight SML, the security market line. It's not something that's part of the paper. It's something that the authors may not, and I understand, so they may not want to incorporate this into this paper, but I find it's interesting for the general audience. I'll have a comment on the source of uncertainty. I would like to know more about what is kind of uncertainty that builds up and what leads to the resolution of uncertainty. So I'll have some little data work on this. They may want to incorporate this into this paper or keep it for a follow-up paper. And I would like to know a little bit more about the implication of macro news announcements to the remaining results. So let me start with the security market line. So in Endershot and co-authors in their GFE paper, they showed that the CAPM holds overnight. But in the paper of Endershot and co-authors, we don't really have much of an explanation as to what leads to the having a security market line that is upward sloping overnight. I think that Oleg and Dima can potentially say something about this, because if you look at Sever Wilson 2014 and some other papers where they've documented risk premium and resolution of uncertainty, they've actually shown in those time periods the CAPM seems to work well. It could be interesting for Dima and Oleg to show, for example, that the SML works dispositively upward sloping overnight only when the EU markets are open, and it's not the case when there is European holidays, because they've Oleg and Dima show in their paper that there is only an upward drift between 11:30 p.m. to 3 a.m. when the European market is open. Also, in Oleg and Dima paper, they show that the drift is higher or more present if prior uncertainty is high. So it could be potentially interesting to show that condition on prior uncertainty during Asian market hours, when it's higher, this is when you should find actually a more positive upward sloping SML. So the result got me thinking about this SML to potentially better explain what the results of Endershot and Dmitry Lipton have found. But I could understand also why Dima and Oleg may not want to go down this path for that paper. My second comment has to do with the source of uncertainty. So there, in the story of Oleg and Dima, their argument is that there is a drift during the open of European market because there is a accumulating uncertainty during Asian hours. There are some fewer active investors keeping the E-mini close to value during Asian hours, but when the European market wakes up, so when European investors wakes up, they push the E-mini price towards fundamental. So one nice finding in Dima's paper is the following. This is the cumulative returns in the VIX, VIX futures. Say this is from 6 p.m. to I think 11:30 p.m. So you can see there is an increase in the VIX, and this coincides with the Asian market hours. And if you calculate the cumulative returns in the VIX starting from 11:30 p.m. until 3:30 a.m., you see that there's a decline in the VIX around 2 a.m. that coincides with the European market hours, and this is where you see the positive drift in the returns. And this got me really interested to understand what the hell is this uncertainty? What is the uncertainty increasing here, and what can cause uncertainty to go down? So I did something over the weekend that's not very scientific, but just to kill some time. So what I did is I went to Ravenback and I collected all the macro news from Dow Jones over a 24-hour cycle from 2016 to 2019. So I kept all the news are not firm-specific news, and they're not only macro news announcements. It's any news that has to do with the US. And I kept only the news for which Ravenback keeps a relevant score of 100. So these are what, quote unquote, are the most relevant news. And then what I did is I plotted, so I essentially took a given day, I sum up the total number of news, and for each hour I calculate what fraction of that hour, how many news for that hour over the total 24 hours. And my priors were that there would be little news before, well, little news late at night and during the overnight period and during Eastern time. Actually, I'm actually quite surprised it's actually not the case. So there's lots of news from 6 p.m. to 1 a.m., because you can see here. And now, really interestingly, there's a spike of news as well at 2 a.m. At 2 a.m., that coincides with the increase in return and decline in the VIX. This spike of news is almost as high as the two big spikes of news you see at 8 a.m. and at 10 a.m. during in the morning for the US markets. These two spikes of news are usually coincide with a lot of the macro news announcements happens either around 8:30, for example, the unemployment announcements, and at 10 a.m. you have all of the other type of macro news like consumer sentiments. And I was really surprised to see that there was an increase in news at 2 a.m. So it's possible that there's a lot of news that comes out overnight, and this spike in news at 2 a.m. helps to resolve the uncertainty that came beforehand. It could be interesting for Dima and Oleg to dig into this a bit more, to what kind of news this corresponds to. If the authors want after, I can share with them the data and my 10 lines of codes that generate this little figure. My last comment has to do with the implication of macroeconomic news. So I previously asked the authors when Dima sent me a copy of the paper if the results of the overnight drift hold if you exclude all macro announcements. I've asked this because recent papers show that the drift leading to a macro news announcement actually occurs overnight. So this is the case in Hu and Hal and co-authors, and my work as well with Oliver Boguth and Vincent Grégoire. In the paper, it says, yes, that the results hold, but there's not much detail. And I would like to say a little bit more because it's important to keep in mind that the overnight pre-announcement drift might be large enough to explain the average daily overnight drift. I don't think that's the case, but I think I would ask the authors to just do a little bit more to rule out this possibility. So if you, for example, if you take the work of Hu and co-authors, here they plot the, I take this from their paper, they plot the cumulative returns for all macro news announcements with macro and FOMC announcements 3 days before the announcements at day 0. So this is the return and this is the VIX, change in the VIX. This is the top two panels here are for announcements with high positive returns leading to the FOMC announcements or other macro news announcements. And this is for what they call here the low group. These are the announcement with the low returns. As what you can see here, the big jump, there's an important jump that happens overnight for macro news announcements, and the drop in the VIX also happens overnight. This effect, however, might be canceled out by some announcements that are negative. It may or may not be canceled out, but it would be really interesting for Dima to do the following. In their appendix of the authors, they have this figure where they plot the cumulative returns for the FOMC announcements from 6 p.m. to next day 6 p.m. And what Oleg and Dima show is that there is, after the opening of the European market, there is a drift in return IWOL that continues, and it continues up to the announcements. I would like to see this figure with all the macro news announcements, not only FOMC announcements, and compare this to another set of sample where they just include all the days with macro news announcements to see that indeed this drift here is robust to the occurrence of upcoming macro news announcement. Because it's possible that at 2 a.m. there are some news that helps resolve some potential uncertainty to other macro news that are coming up later during the day. I don't think that's the case, but I would like to see a little bit more to rule out this possibility. But overall, it's a very neat paper. It got me really interested to dig into more overnight macro news cycle. I actually have more comments for Dima, but I'll share with Dima tomorrow, actually. So thank you very much.
Great. Charles, thanks very much. There was a comment in the chat from Tobias Sichert, but Charles actually raised the same issues in detail during his discussion, so I don't think I need to ask the question. So actually I should say, Dima, I guess we have time for you to give a short, and I emphasize short, response if you want to.
I mean, this was a wonderful discussion, probably even better than my presentation. We just looked at we just included like the main US macro events. We certainly can look more into this. So great discussion overall.
Okay, so we have a few minutes for questions. Again, if you'd like to ask a question or make a comment or tell Dima he's wrong or whatever, feel free to unmute your microphone and ask your question orally.
So this is Albert Benkveld. Can you hear me?
Yes, certainly. Please go ahead.
Yeah, so this was wonderful, both the presentation and the discussion. And of course, what got me a bit confused in the presentation, Dmitry, is you're talking about the Asian, the VIX going up in Asian time zones because there are few large investors or something like that. So I wasn't sure if that's necessarily important. We just need one investor under competitive conditions to take the price all the way to what it's supposed to be. So could it not simply be that information on the world economy, given that in your time, probably most of the world economy is still in the US and Europe altogether, that whatever comes out in terms of information during European trading hours is very important for the world economy to assess the world economy. And if this is sort of what's going on, so this is not a point about the number of investors, is a point about where the information is being produced on the world economy. And if this is going on, then maybe, I don't know, the time span of your sample, given that the Asian economy is becoming so much more important in the world economy, some of the effects in the course of your sample might become smaller, simply because Asia becomes a larger and larger part of the world economy. Let me stop here.
So first of all, this kind of like goes back to Charles' point about kind of the information production side of it, where the news come from, what kind of the news are there. To comment on your other two questions is sample period is 2004 to 2018. Indeed, during this time, not only Asian economy became more important, it was already important in 2004, but the Asian trading volume quadrupled. We find that EU open returns stayed very, very consistent through the entire sample period and were not affected by changes in Asian importance or Asian trading volume. Your first comment is about the standard assumption and microstructure model is that if we have just one arbitrageur who is clever, he will correct the prices. I think what we have in mind here is, well, in the real world, the information is like much more multifaceted. So some of this is, I don't know, like satellite images. Some of it is how related securities move. So not a single investor would be able to process this. The analogy I would use is sort of like Amazon reviews. Imagine you have a product which has just 10 Amazon reviews. Is it a good product or not? Now imagine that we have 100 reviews. So now we can have more certain whether this is a good product or not. And the context of the news is whether investors will veto different pieces of the news and say whether they are positive or negative. This being said, is again, it's difficult to explain this puzzle. What we find is uncertainty resolution fits best than other explanations, but it by no means is a perfect explanation to everything that we see here. Thank you for the question.
Yeah, thank you.
So, Corbin, I know that the question was retired by Tobias, but I would still love for you to expand on the FOMC returns constituting the days where most of the equity premium is gained, and then the consistency of this European Open positive returns. Does that mean that they are exactly the same on FOMC and non-FOMC periods? And does it just mean it's the rest of the day that do more poorly outside of the FOMC period, or do you simply have different results than the other FOMC papers?
Can you share? Can you see my PowerPoint? So because it's better to just.
Yep, we can see it.
So this is the return during FOMC days. So what happens on FOMC days is we have an overall pretty large return. So in FOMC days, if you trade them, there are 8 FOMC days during the year. If you trade them during our sample, you can earn about up to 2.5% per year, about 2.5, right? So if you buy here, you sell here, that adds up to about 2.5%. FOMC announcements are at about 2.15. So it's what you can see is that EU Open returns are slightly larger on FOMC days than on other days, but if we exclude those, EU Open returns are pretty much like, well, they decrease a little bit, they remain still very large. I think we have the numbers in the paper. The way we think about this is that on FOMC days, you can earn a lot, but only 8 times a year. EU Open, you can make some money almost like every other day. So EU Open actually adds up to 7.6%. FOMC is about like 2.5%. So what we think about it is that these are 2 separate puzzles that speak to why equity premium is positive sometimes and 0 otherwise. We don't kind of find a direct connection here. But maybe it's a good idea for the follow-up paper. What we did find, as you can see from this graph, the pre-FOMC drift on the day of the announcement, it starts at almost like exactly at the beginning of EU Open. So no pre-FOMC drift during the Asian session, but on the FOMC announcement, it does start at pretty much the same period. But no, like, I don't know whether I kind of answer your question well, but yeah. It seems to be like 2 puzzles.
It's perfect. Basically, if you took the extra return in the EU Open period out of the overall daily returns on FOMC meetings, or looked at the other days, you only deepen the puzzle, if anything, right? You basically say that the equity premium on non-FOMC days is even lower in some sense. It's boosted a little bit by the EU
yes,
on those days as well. So,
very good point.
No, it's trivial effect is my guess, but it's still very interesting, and I see why you call it 2 separate puzzles. So the other macroeconomic announcements, I think you said you looked at some. They have no systematic patterns, or do they? Of this sort?
I mean, FOMC really stands out relative to other macro announcements. There was a good paper recently about this, but we just excluded those daily dummies. We should look more closely at them. We looked at FOMC just because every time we present the paper, someone asks us about FOMC. So we looked at FOMC. We should look at other macro announcements because we see, like, you ask about other macro announcements, Charles asked about other macro announcements. We should look more closely at them.
Thank you very much.
All right. Any other questions? Last chance.
No, this is, yeah, go on. Go ahead.
I think you're up, Albert. No.
Okay, no, I thought that somebody else was wanted. I don't want to jump in front of people, but you know, building on Torben's point, if you look at the European landscape, of course, there's potentially a lot more macro announcements that are relevant because we've got all the central banks separately, and then we've got the European Central Bank, and so that for that reason there might be a lot. It's not surprising that you then see, you know, every other day there is this what you call anomaly. Maybe it's just a compensation for risk that people are earning when they take the market, a long position on the market ahead of these announcements. So the thing to do then is basically to collect all those days where there is a European announcement, macro announcement, and see if that's the days where you get the positive returns. It's very interesting.
Well, this is a great point. We should do this. And also, like, to reiterate, we don't think that this is like some kind of, we think it's an anomaly, but our preferred explanation, it's also risk-based. So it's not like investors get free lunch. They're kind of compensating for taking risk. Whether this risk is realized on European macro announcement will be interesting to see. We haven't checked that.
Agree.
Dobrislav Dobrev here. I was trying to also make just a very quick comment on. First, I fully second the importance of accounting for the relationship between U.S. equities and global growth news, which has been strengthening over time. And second, I also wanted to mention something purely mechanical about the way the exchanges operate that may warrant some investigation. For example, the New York Stock Exchange holds an opening limit order auction at 4 a.m. Eastern time. And the limit orders can be entered after 3:30 a.m. So I don't know the extent to which other trading venues for equities may have something going on in those early hours when some of these effects take place. So I just wanted to throw this as well.
Thank you.
Okay. Any other questions? Last opportunity to ask a question. Last opportunity to tell Dima he's wrong. All right, then. Thanks very much. I guess there are two